Okay, so today is the 20th, or Groundhog Day number 35 if you're keeping count, and we're starting on chapter 9. I talked a little bit about it before. For the most part, we've seen all of the things about the cash flow statement before and even had to make some calculations, especially when we went through the cash and current assets, and also when we went through investments and long-lived or non-current assets. So for the most part, this is going to be stuff that you have seen before. You just might not have seen it in the cash flow formats, but I've tried in many of the chapters to present the cash flows moving on from chapter 3. I know we didn't always get there, but it was part of the work that we did have turn in at least 3 or 4 times. And it was almost always on the handouts with the solutions there. So you can kind of see where it's coming from. We're going to be talking about indirect cash flows and direct cash flows. For the most part, the book has adopted a direct cash flows method, but in corporations, when you look out there, they largely use the indirect method. And to be honest, I think it's kind of to obfuscate some of their exact figures. It is much more of a pain to do, and um, it's harder to interpret, which I don't think they're trying to fool anybody. I just think they don't want to give exact information out to their competitors. And I think the direct method can be easily more informative, whereas with the indirect method, you kind of have to dig a little bit. So there's a few things that I'll remind you. Um, Depreciation and amortization are never cash. So keep in mind, we don't count depreciation and amortization. They're never cash. So that's one of the most important things that you should get out of this class. They're an expense related to accounting. And so sometimes businesses will look poor on paper because of the investments that they made in property, plant, and equipment. But you'll hear somebody say they're going to go bankrupt, but the stock is going to rebound or the company is going to be fine because they have solid cash flows. And so on paper, they can look like they're losing money if it's due to depreciation and amortization, but they can still have positive cash flows, be able to pay their debts, be able to continue to operate. And in some cases, those are actually decent investments. I'm not recommending any investments to anybody, but if you look back at companies like Amazon, and there hasn't been another one that I can think of similarly now, because a lot of companies don't rely on physical assets. But if you were relying on physical assets, you may run a negative net income for a while, which Amazon did as it was building up its infrastructure. And now they've started to turn a profit, and they're able to kind of get beyond that depreciation and amortization. The other thing is that governments tend to like to see investment. And so depreciation and amortization will reduce your accounting income, but often result in some cash coming back from you if you've done those, if you've made investments in certain areas. So it helps the company operate and invest in new projects um, versus staying stagnant. And that's really what investors want to see. So I'm going to go ahead and share my screen with you. And the quantitative questions start with learning objective 4 here. There are a few basic ones that I skipped over for learning objective 3, but it's going to be important for this chapter that you read sections 1, 2, and 3, because I would guess of the chapter 9 questions, the majority of them are going to be concept-based, and those concepts are going to come from learning objectives 1, 2, and 3. I'm not covering them here because it digs down a little deeper into what we had done in the past, but we've already talked about them, so it should be a review for you. That doesn't mean you can't ask questions in the next class if you're reading through. You have a reading quiz today that is due before midnight, and it's again, going to be representative of the types of questions that you'll see on the exam. That isn't to say that what we're doing is not important. It's just here I think our focus can be made a little bit better on the quantitative questions. So reading is important. If you have any questions on those concepts, please let me know. We're going to focus on the quantitative because I think it can be a little bit confusing. All right. Any questions so far? If you do, just type them in that chat. All right. Okay, so I want you guys, and I'm going to pull up the chat here. Tell me a little bit about what you know about cash flow statements. Just little short excerpts in the chat and what you know. And if you don't know anything, go ahead and type in there, I know nothing. Good. Thank you, Taylor. Good. I hope that's I hope that's comedy, John. So all right, so the statement of cash flows is one of the important accounting statements. Shows the cash inflows and outflows divided by activity type, activity type types, which include operating. These are the activities, the ongoing activities of the company. Investing. These are purchase and sale of non-current assets. Acquisitions. Sorry, I should put cash acquisitions there. Cash acquisitions. And investing activities. I'll say financial investing activities. Okay. The last one is financing. And these are activities with, I don't know why I keep missing that last I, activities with ownership, shareholders, and debt holders. excluding interest expense, which is an operating activity. On a side note, notable non-cash transactions are reported in the notes to the cash flow statement. For example, acquisition of a business with treasury stock. Okay. So we have our three parts, our change in operating, change in cash due to operating, plus our change in cash due to investing, plus our change in cash due to financing, and that equals our net change in cash, which we add to our beginning balance, and that equals our cash ending balance. Okay, a couple notes here. Net change in cash can be negative as long as the company has cash reserves or a line of credit available. So somebody asked, are dividends part of the financing activities? And that is, it is correct. They are part of the financing activities. They are part of the transactions with ownership. And so we'll kind of just talk about some of those activities here in a second. All right. So it can be negative as long as the company has reserves or other line of cash available, or excuse me, a line of credit available. Now, on some of the questions.
Can you scroll up like a little bit?
Yep, give me 1 second.
Thanks.
Yep, you're welcome. On some of the questions, the text asks what amount is needed to cover ... and usually that's investing or financing activities. And for these questions, want to know how the third activity, or what number the third activity will provide in order to have a net zero change in cash. Okay. And I'll show you an example of some of those questions as we go through. All right, so I kind of gave a basic overview of what types of transactions go into them, talking about operating, talking about investing, but I didn't get specific. Now, from what I gather, there's not too much misunderstanding with that. So if there are no questions, I'm going to move on to some of these other questions. But again, make sure you read the chapter. It's going to be important. Okay. All right, so 9.1 says the following information is from the 2011 annual report. Keep in mind the dates here. One of the things that this text does that I don't really love is that it shows the same question, but then it swaps the names of the company and it swaps the dates. So try not to blaze through the questions quickly here. All right. So we want to know cash collected from customers in the statement of cash flows. And so cash collected from customers comes from where? Type it in the chat. All right, so several good answers here. There was one that was complete. And so you have kind of two things, cash from customers comes in two ways for a for-profit company. Cash sales plus collections on accounts receivable. And then occasionally there are deposits in advance. All right. Sam is making me laugh. I understand. All right. So we look at the information and we have sales revenue of 90,000. So we start with sales, 90,000, and then we add the change in accounts receivable. So when we look at accounts receivable, the accounts receivable balance went down. And I'm sorry, I'm trying to get this all on one page, so I'm gonna move a couple of those up there. Just give us a little bit more room. Okay, so we had 90,000 in sales, plus we had a $2,000 decrease in accounts receivable. It went from 10,000 to 8,000. Absent other information, we assume the 2,000 decrease was cash received. So 90,000 plus 2,000 equals 92,000 cash from customers. Okay. Okay, now the next one says cash paid for salaries on the statement of cash flows is going to be equal to, so here we're going to do the same thing. We're going to take our salaries expense, and that's 30,000. We're going to add the change in payable. It went from 3,000 to 2,000. So we assume the company paid $1,000 more in salary to reduce the payable. So 30,000 plus 1,000 equals 31,000. Any questions on the first two?
Yeah. So with the first one, are we assuming all those that sales revenue was cash?
So we're not assuming it was all cash. We're assuming that it could have been either, but if it was on accounts, that it went through the accounts receivable account and was received in cash. Does that make sense?
Yep.
Okay. All right. So before we kind of move on to the next question, here's the basic assumption of the indirect cash flow method. I should say here are the basic assumptions. If a current asset increases, the company used cash to buy the product. I'm sorry, that's not to pay for the increase. If a current asset decrease, the company generated cash from that decrease. Okay. If a current liability increases, the company was able to hold on to cash. If a current liability decreases, the company used cash to pay it down. Any questions there about sort of the basic rules? Okay. All right, let's move on to 9-3. All right. So here we don't have accounts receivable because it collects its cash from customers in advance. So I want you to take that into consideration, and I want you to try 9-3. I'll give you about 2 minutes and type your answer in the chat. Remember, you're not being graded here, so do your best to answer. I'll answer your question, Juliana, in a minute. Good job, Dylan. Everybody's fallen for the wrong answer here, which is good, so we can talk about it. All right. So again, I want to highlight this because I want you to pay attention to what's happening over here. So we had a current liability, unearned revenue decreased. And so kind of with our general rules, if a current liability decreases, the company used cash to pay it down. Now that's kind of a general rule, a basic here. But if we start with sales, 80,000, then we add the change in unearned revenue, which in this case is a decrease of 4,000. We have 76,000. So Juliana, this gets to your question. We are adding each time, but sometimes we're going to be adding a negative. So when you're talking about paying it down, that's going to be a negative. When you're talking about building up your assets, that's going to be a negative as well. That's an outflow of cash. Here, their liability decreased, which meant that the companies that were paying for their services or paying for their revenue didn't pay as much in as they did in the prior year. And so if we kind of think about it on our equation, we have unearned revenue, beginning balance, plus deposits, minus earned revenue, equals our unearned revenue ending balance. And so here we started with 9,000. It says all of the deposits are always collected in advance. So we had 80,000. No, I'm sorry, that was the earned revenue, sorry. We don't know the deposits minus our earned revenue, 80,000 equals our ending balance of 5,000. So combining like terms, we have deposits minus 71,000 equals 5,000. We add 71,000 to both sides. And we get deposits equal 76,000. Any questions? All right. We did a lot of chatting, or I guess I did a lot of chatting, but I was hoping to see how you guys were doing. Let you know I appreciate you guys. Let you know I know the struggle is real. So if you don't have any questions, you are free to go. If you have any questions, let me know. I have to run a quick errand after this. So if you need me for office hours, I'm going to be in the other room. Just shoot me a text message and I'll come out. But I'm going to be downstairs. So the answer here, by the way, was 76,000. Have a great day, everybody.
Thank you, Professor.
You're welcome, Dylan.